I'm Owen Bigland. This is the Inside Edge video blog. Okay, it's Saturday, so I'd be remiss if I didn't talk about what's going on in the financial markets, in the Dow, in the S&P 500, NASDAQ, the Canadian market. So we've gone through a pretty rough month here, 6 weeks. It's been a tough year. Since January of this year, the markets have been in turmoil. Buying the dip has been pretty effective here up until recently. Now, of course, we've taken a pretty big dip down as I speak. But, just wanted some positive affirmation for you guys. Do I look like I'm worried? I mean, I can tell you the paper loss, it's not a loss until I sell the stock, which I'm not. These drawdowns or these losses in my portfolio don't mean anything. They're just on paper. But, they are well in excess of well over $500,000 here in the last 6 weeks. My portfolio has taken a hit. I don't lose any sleep over this stuff whatsoever, and neither should you guys if you own the proper equities and the proper assets that I've done tons of blogs on over the years here. These are quite normal. As a matter of fact, a guy like me who's still in his accumulation stages, I'm still a working realtor. I make, a nice living doing what I do as one of the top Vancouver realtors. I've got dry powder still coming in every single week in the form of my commission checks. And then with the size of my portfolio, in a good month, I have $10,000, $15,000 coming in the form of dividends. Yes, I have a big portfolio. You do the math on that. Some guys question, how could you have $10,000 in dividends or $15,000 of dividends? Well, I've got a big portfolio. I own a lot of Apple. I own a lot of Johnson & Johnson, Macdonald's, Bell Canada. I've got over $500,000 in the Canadian banks, which pay me a fat dividend every quarter. So I've always got dry powder coming in, and I'm putting it to work. I don't try and time markets. As this dry powder comes in, I put it to work in stocks or ETFs, because I do a lot of index investing, that I think are fair value or good value. I'm not trying to time a bottom. And you guys should neither. As Jack Bogle would tell you, or Warren Buffett, just systematically keep buying. Dollar cost average into these high quality companies. Don't just buy anything. We're seeing a day of reckoning now, which I knew we would, on these meme stocks and all these high-flying tech stocks that had no profits. Not only did they have any profits, they didn't even have any roadmap to getting any profits. You're seeing these now getting completely wiped out. And that's part of the reason why the broader indexes and a lot of the quality tech names like the Apples and the Googles and the Microsofts and the Amazons are also getting sold off. These are good opportunities. They throw the baby out with the bathwater on these broad market sell-offs. And there's a lot of stuff going on. We've got interest rate hikes, which of course, the higher interest rates go, it makes equities less favorable. And we knew this was coming. This has been talked about for 2 years now, that eventually interest rates are going to go up. They're going to take the punch bowl away and the equities would go down, which it has. Markets also tend to get oversold. The pendulum swings way too far in the other direction. We're probably getting close to that now. If you follow me on Twitter, I've been tweeting out some things, some of the stuff I've been nibbling at, topping up on companies like Estee Lauder and Disney. I just recently topped up some Apple in the 140s. Even though Apple makes up a huge percentage of my portfolio, I'm overweight in Apple. But at these prices, for an investor like me, I'll buy it, hang on to it for 5-10 more years, and then reevaluate it and collect the dividends in the meantime. So there's some good value there. But my message here is just for you guys to stay the course. Try and take advantage of these high quality names that are on sale. But don't just buy anything. And I've been buying probably 50 cents of every dollar I've been putting into the market. I've been putting just into the indexes. I've been buying the VIG, the Vanguard Dividend Appreciation Fund, which I've talked about many times, one of my favorites. The S&P 500, VTI, which is the Vanguard Total Market. I've been putting money into the Triple Q. I've been putting money into XIC and XEI for Canada. And then I've been buying some individual names as well that I think are at good value. Had a guy, on my Twitter feed, I was tweeting out some things that I was buying a few weeks ago. And, of course, you always get these haters, the market's bottom, it hasn't bottomed. There's still way more to go. Listen, again, I'm not trying to time the bottom. This isn't money that I've had on the sidelines for 10 years and now I'm finally going to buy. I just systematically buy on the way down, and there's always good value. And then there's some of my holdings right now, like a General Mills, a Coca-Cola, a Pepsi, McCormick, Procter & Gamble. I've got a lot of names that have hardly been scathed in this, and that's why you want to use that barbell approach. The stuff that's really been hit for my portfolio is the tech side. Although I don't have any of these kind of high growth, no income, no revenue names. I've only buying large cap stuff like the Apples and the Googles. But that's been hit by far the hardest. But my Canadian banks, a lot of my consumer staple stuff, the ones that are paying me a higher dividend, those are off not anywhere near about a quarter of what my tech stuff is off. And that's why you want that, what I've called that barbell approach. You want some of the growth stuff, but you still need those old stodgy, dividend payers that keep the dividend growers. Sure, you're not going to get 100% return on them over the next 10 years, but they're slow and steady, the Bell Canadas, the Teluses, that pay you a solid growing dividend, and that helps mitigate, some of your losses on the other side, on the more higher growth names. The thing that I've talked about many times, and I talk about in my book too, is the power of dividends, and why most of my portfolio is based on dividend aristocrats or dividend growers. Companies that not only pay a dividend, because remember, you never want to chase yield and just buy a company that has a crazy high yield. Those are never sustainable. You want to go after companies that pay a nice dividend, but then have a long track record of increasing that dividend. That's the sweet spot. That means that they've got profits, they've got wide competitive moats, lots of free cash flow. Those are the companies you want to own for the long term, and that should make up a good portion of your portfolio, because the dividends will always be there. Even back in 08, 09, and even during the COVID correction 2 years ago, very few companies of mine eliminated the dividend. I had a few that temporarily cut it. They're all back except for one, which is Disney. But the vast majority of my holdings not only paid me that quarterly dividend, but continue to increase it. And these companies will continue to do that. Just offhand here, Apple just increased their dividend 6%. The Canadian banks here next month are going to start another round of dividend hikes. Not a month goes by when I'm not getting an announcement from one of the companies. So that will help you stay the course. The overall portfolio value might go down 15, 20, 20%. But remember, that cash dividends you have coming in quarterly should continue and should continue to increase over time. My dividend growth rate right now on my total portfolio is probably hovering close to 10%. So well above inflation still. And inflation, I think we're going to get under control here. It's already come down a couple of points here. I think maybe the worst is over. Let's see how it moves into the summer. I think a lot of this stuff is transient. It usually is. They get settled in the end. The Ukraine thing, that'll probably get settled. The supply chain problems, a lot of this stuff, they come and go. And you buy when it's the darkest out there and there's the doom and gloom and everything else. Tweeted out a few things just to close off here. As Warren Buffett said at his annual shareholder meeting for Berkshire Hathaway, the stock market is a transfer of wealth from the impatient to the patient. Remember that. Buy, hold not just anything though. Index invest, hold high quality names, buy them when they're on sale like they are now, and just keep them. Collect the dividends and just keep reinvesting into whatever you think is on sale at the time. It doesn't have to be more of that company. The big money is made not in the buying and selling, but in the waiting. And you could tie that into Vancouver real estate as well. I did that blog with the update on the current market. Market's starting to slow a little bit here, which is expected with the interest rate hikes and the buyer fatigue. Buy and hold. That's what my basis of this entire video channel is on, as well as my book, Along for the Ride. It's nothing fancy here. You're not going to be able to trade in and out of the stock market or out of the real estate market. You will eventually, the friction costs will grind you down, and especially in the stock market. Nobody knows where the markets are going. Instead, just buy high quality companies, preferably that pay you a dividend, hang on to them, buy more if you can when the price is on sale, and you will do incredible over time. And you know, if you're having a hard time during this market right now, I suggest two things. Don't look at your portfolio. If that really is going to bother you when you open it up and it's down another $10,000, just don't look at it for a while. That's what Jack Bogle would always say. Take a break. Close off the account and wait till the market recovers, which it does, before you go back in. Or if you're really having trouble sleeping at night, do what I do. Just don't drink coffee after 11 a.m. That's all there is to this. My portfolio has been taking a real beating here, but I'm using this as an opportunity to buy. I'm not worried in the least. I'm still getting these fat dividend checks coming, and pretty much all these companies that I'm holding are raising their dividends. The only one that I have, as I say, currently right now, which I just bought some more of, is Disney. Incredible company. It's trading at just over $100 a share right now. It was at $185. They've suspended their dividend during COVID. I would expect them to reinstate that maybe later this year. But for the most part, dividends will help you stay the course, and why you should own some that pay you a dividend and continue to grow it. But these corrections, these sell-offs, I'll do another blog here coming up on another Saturday on the reasons why this sell-off is here, and how a lot of stuff, the baby gets thrown out with the bathwater. They generally get oversold. You got to let the weak hands get flushed that don't know what they're buying or don't know what they're holding. They haven't constructed their portfolio in the right way. But use these as opportunities. Don't worry about when your portfolio takes a 10 or 15 or 20% correction. It's very normal. You will stock markets, real estate markets never go up in a straight line. There's always going to be pullbacks. It sets the stage for the next rise up. I'm Owen Bigland. As always, have a good weekend. I'll see you next week.